Okay, welcome everybody to today's webinar, Mapping the $400 trillion future of tokenized assets, hosted by Keyrock alongside Midas and RWA.xyz. I'm Ben Harvey, Digital Assets Researcher at Keyrock, and I'll be moderating today's discussion. We've got a fantastic discussion lined up for you today, which will be basing on Keyrock's latest report, which examines what it actually takes for tokenized assets or RWAs to scale into trillions. So today we'll be digging into questions like everything from what's really holding adoption of RWAs back to how on-chain markets are evolving around RWAs. So let me introduce our speakers. First up, we have Dennis Dinkelmeyer, CEO and co-founder of Midas. Dennis, would you mind briefly introducing yourself and Midas?
Yeah, thank you, Ben. Thank you for the introduction. I'm originally from Germany, but I'm based in London, the UK. And I serve as CEO and founder of Midas, be an asset tokenization company. We were started 3 years ago, and we bring on-chain investment products into DeFi and on-chain markets. We processed around $2 billion of tokenized assets last year. And we're one of the, I would say, leading tokenization companies, bringing all sorts of products live, including tokenized stocks, tokenized investment strategies, and even some asset-backed strategies via different configurations. So super excited to be on the show.
Cool. Thank you very much, Dennis. And somebody that I'm sure spent a lot of time looking at what Dennis is doing is Dean Khan Dillon, Head of Growth at RWA.xyz. Dean, would you mind doing the same, just introducing yourself and what you do at RWA.xyz?
Yeah, sure. And cheers for having me, Ben. Excited for this one. So I'm Head of Growth at RWA.xyz, so leading partnerships and marketing. And for anyone who doesn't know us, you can think of us like Bloomberg for digital assets. So we track kind of all real-world assets across major asset classes, and Midas are a close platform partner as well. And we're kind of the source of truth for tokenized assets. So cover anything from on-chain data to off-chain data, legal and regulatory structure, who service providers are, really enabling kind of discovery of all assets in the space.
Yeah, and we're definitely big fans of what you do at Keyrock. I mean, for anyone who's read our market commentary, there's a big section dedicated to RWAs, and all of the data comes from RWA.xyz. So yeah, really, really glad to have you on. And finally, it's a pleasure to introduce Amir Hajan, my fellow researcher at Keyrock. Amir, do you want to introduce yourself quickly?
Yeah, so I'm a researcher at Keyrock, like Ben mentioned. It'd be a bit of self-appraisal to say thanks for having me on. but yeah, I mean, I'm the author of the RWA piece that we did, and me and Ben, we both co-published the research reports that we put out. And this time we had an in-depth look at RWA. So thanks for having me on.
Okay, fantastic. Thanks, Amir. So with that, why don't we get into it? We'll kick off the discussion by looking at a key finding of the report, which was that token issuance of RWAs is, we think, broadly been proven, yet less than 1% of assets in the world have actually been tokenized. This figure obviously differs by different asset classes. So treasuries, much higher percentage, and then alternative investments going to be a much lower percentage. Dean, why don't we kick off with you? It'd be great to get your thoughts here. What do you think is the bottleneck that's kind of been holding back RWAs and why we only have 1% penetration so far? Is it regulation? Is it liquidity? Or is it the fact that institutions just don't trust the infrastructure yet?
Yeah, I think, like you said, there's no real lack of issuance. I think the supply side of tokenization is largely solved. Issuers see the benefit of tokenizing their assets. I think the bottleneck, it's a combination of a few variables, which is holding back the demand side. And just to make this easy, supply side is issuers and demand side is capital allocators, or at least that's what I'll say for the rest of the conversation. So in terms of bottlenecks, yeah, there's regulatory uncertainty, there's lack of liquidity in secondary markets, there's the macro environment right now with slightly higher rates in America, which can make sudden on-chain products less attractive. And then it's also kind of hard to discover and compare these assets. So there's quite a few factors at play. But if I were to sum it up into one core issue, I think it's that huge capital allocators and big banks are concerned with the reputational risk. So we speak to these allocators every day, like the Fidelities and the JP Morgans and the BlackRocks, and they're worried that if they allocate large amounts of capital on chain and that goes wrong, that could act as a bit of a punch in the face to their brand value. So for some of these guys, I think the risk to reward in the space just doesn't make sense. And then as a secondary factor, I was talking to a capital markets MD at a major bank yesterday, and I think distributed asset value is around $29 billion or $30 billion, and he was saying how any one of his given deals could be in that range. So one singular deal they do is the size of the whole space, which just shows kind of how small it is in the grand scheme. And obviously these banks want to be confident that, you know, if they undergo a major deal or put a large position on chain, that does not move markets. So it's almost a chicken and egg problem as well in terms of liquidity. But yeah, that's what I'd say. I'd say one, it's reputational risk, and two, liquidity.
Yeah, it's very interesting. I remember talking about reputational risk when probably like even in the last 3 years, we would talk about career risk, right? Like for investment managers to actually allocate to something like Bitcoin, huge career risk, because if it goes wrong, you know, you're kind of shooting yourself in the foot a little bit. I think that's gone away massively, but now it's shifted over to, are you actually going to allocate into the infrastructure as opposed to just kind of like the entry level asset that we were talking about a few years ago. Dennis, I'd be interested to get your thoughts here. Do you think that meaningful adoption of tokenized assets depends on some kind of integration with traditional exchanges like the New York Stock Exchange or CME that could maybe mitigate some of those reputational risks? Or do you think that on-chain native markets can actually just scale?
Obviously, it's an unpopular opinion in the industry, also being a huge proponent of tokenization and on-chain financial markets. But the realistic answer, when I really look at this with a sober perspective, is yes, we do require integrations with traditional venues. Even if a lot of people in crypto don't like to believe that, when we look at the crypto financial markets, we actually see the same. So when you really look under the hood, 60-70% of trading volumes is happening on Binance. Binance is not a decentralized technology tool. So most crypto assets actually settle on centralized assets. I think in aggregate, and of course, Hyperliquid is growing very well, and it's a very interesting, promising, and exciting trend. But even when you look at all trading activities across all crypto assets, less than 10% of it really happens on chain, and this is really an optimistic scenario. So even within the crypto space, venues where latency and convenience and other considerations cross margin matter, we rely on traditional trading exchanges. Now, when you look at this in a traditional sense, in the traditional financial worlds, between New York Stock Exchange and Nasdaq, you have sizable volumes. So if you really look to scale this industry to the billions, U.S. equity markets alone are something like $60 trillion asset class. I mean, that's really the market cap of assets currently traded on Nasdaq and New York Stock Exchange. So when you look at this, it's really a promising potential. When you listen to the statements of the new SEC chair saying that he believes that all trading activity within for US equities will move on chain within the next year. So that's quite an exciting prospect, to be honest, and really a huge game changer. So I very much agree on the comments previously stated that Dean highlighted. The industry, of course, is making great progress, but really in the sort of absolute scale of things, it's really a drip in the ocean compared to traditional financial markets. I previously had the opportunity to work at Goldman Sachs and Capital Group. At Goldman, some of these deals we were doing were comfortably in the same range that Dean has mentioned, and Capital Group is a $3.5 trillion asset manager. That exceeds the market cap of all crypto, including all Bitcoin, including all stable coins. That's just one asset manager.
Yeah, it's incredible. I mean, once we cross that bridge, it should bring a lot of capital into our industry, or the hybrid between the two. It sounds like you're feeling quite optimistic about kind of these centralized players integrating then. I think we've seen, I mean, you mentioned the year, it's quite an aggressive timeline, but we've already seen some collaborations between, I think it was NASDAQ and who else?
I think on a very fundamental level, I think the technology has very valid propositions, but it has been regulatory uncertainty at the very core that really has hindered the further adoption. Over the last 2 years, you've seen a regime change in the largest financial markets in the world, United States, and that really opened the door for applications. Of course, it still doesn't happen overnight. There's a lot of processes that have to happen, but the Clarity Act, MiCA, and other regulatory regimes do add clarity, especially for traditional financial actors, to engage, and that really paves the way for much larger adoption. I mean, if you really want to get traditional financial firms to onboard, you have to mitigate these issues with regulatory uncertainty, reputational risk, Fed fingering. I would say DeFi is ideologically a great idea, but even today, much of DeFi is not really decentralized. It's really protocol-based finance, on-chain finance, and that has a lot of merit and potential. But as you see with some of the day-to-day activities, that there has to be a level of sophistication and guardrails that you have traditional financial markets to really scale adoption much further.
Mm-hmm. And how much do you think that the kind of exploit that we've seen in the last 2 weeks impact these kind of progress that we're making in this field?
I don't want to comment on any particular incident, but it is obviously the case that we had 3 incidents in roughly a quarter that at each volume or value at risk of something like $100 million plus. And that definitely is something that should be closely monitored. I think any asset that trades permissionlessly and cannot be seized bears the risk to be an attractive exploitable asset. It might actually be a derivative of AI. I think a lot of hacker groups become much more sophisticated in coverage, and it's one of the things we at our company investing significant amounts of money into to tamper-proof our security procedures. But it's definitely something that should be monitored very closely. But I would actually expect that all sorts of phishing and social engineering, which is the biggest attack vector, is not often technical. Most of these attack vectors are traditional rails. They will affect traditional finance too, not just crypto.
Yeah. Okay. Yeah. Great point.
And I just wanted to add a few points about the traditional infrastructure moving on chain. I mean, there's a few things, especially on the issuance side. I think what Dean was mentioning too, as far as why this switch from traditional infrastructure to on chain needs to happen. The first thing that we see is, as far as like the valuation methodology, it's very hard for an underlying asset that doesn't trade 24/7 to be able to price it on chain when you have to price it during off hours when it's not trading on the traditional exchanges. So there typically is a NAV to token price mismatch, which needs to get rid of by integrating traditional infrastructure. Then you have other things like guardrails that institutions care about. These are things like pre-trade limits and kill switches and circuit breakers. They're not native to DeFi, and they're not currently integrated with institutional risk systems. And these are other things that institutions care about. And then when we talk about the specific risks that that users have when they're actually transacting on chain, institutions care about seeing their aggregate risk across different protocols and on different chains. So I think in order for tokenization to truly scale, you need to have the traditional incumbents coming on chain and integrating their own systems with DeFi to understand these risks better.
Yeah, it's a great point. It's a great point, Amir. And look, I think maybe drilling down a bit further into that, and I'm sure there are other areas that you can expand on as well. If you had to bet on one asset class winning out in terms of tokenization over the next 18 months, where would you put your money? Did the infrastructure come into play for different asset classes?
Yeah, I mean, this is similar to what we had, in the report with Securitize. We think that treasuries will be the ones that scale fastest because, I mean, I truly believe that as a product, they're much better than stablecoins because on one end, with stablecoins, your counterparty is the actual issuer, people like, Circle and Tether, whereas with treasuries, the counterpart is the U.S. government. That's not to say Circle and Tether are not fantastic companies, but it's a risk-free rate essentially with what you're getting with treasury yields. And you are actually getting yield with stablecoins. It might depend on where you're actually holding the stablecoin to get that yield, whereas with treasuries, you inherently get it. And that's why we see with institutions, they hold more treasuries than they do dollars because they're earning yield as they're using it for collateral. In fact, I think stablecoins got adopted first because tokenized treasuries didn't exist, and the migration. I shouldn't really call it a migration, but we expect treasuries to eat into more of the stablecoin share as those same use cases like collateral and lending get built up for treasuries, because inherently they're much better products because they give you that yield. Now, outside of that, we see equities which are sitting around a billion in AUM as the breakout class, because there's significant interest in traditional exchanges moving on chain, and in making markets 24/7, and of course like pricing more efficient. Of course, we see that with hyperliquid. There's significant interest in people wanting to know when a specific geopolitical event happens, what the price of a certain asset is. Traditional exchanges have to wait till Monday to figure that out. And Ben, to your earlier point, as far as regulatory and developments, we have the New York Stock Exchange and NASDAQ, which are tokenizing the asset. You have the CME that's tokenizing the collateral. You have the DTCC, which is looking at tokenizing the post trade. So as far as the regulatory standpoint, they're the closest in bringing traditional infrastructure on chain, because the current state is just mainly, as far as trading on equities goes, is synthetic wrappers which give you price exposure, but they don't give you the voting or the shareholder rights. It's more of a claim on an SPV. So eventually those wrappers will be replaced by the real tokenized equity as this infrastructure comes over. And then, going down the list, we had commodities, for the same reasons, that we mentioned about people wanting to know what happens on weekends and for pricing to be available over the weekend. But also because, thanks to Dean's RWA data, we saw that, commodities have the highest velocity out of any other category on chain today. I think it's about 150% of their AUM that gets turned over monthly. And, we're seeing usage across sexes in lending and collateral, and they're not just held for exposure. So, outside of, the commodity exchange's own interest in moving 24/7, I think, on chain, they're actually being used by participants outside of just holding. And then alt funds and private credit, have scaled massively. And there's a lot of positives worth leading into, like, the minimum investments dropping and faster redemptions. And, specifically for private credit, as figure shows, there's a lot of per loan savings across the credit life cycle. But, the underlying loans, are still bespoke and marked to model and can be infrequently priced. So we believe that, that the other category classes will scale fastest, and alt funds and credit will be below that.
Okay, yeah, fascinating. I think you touched on a really important point there to do with the tokenized equities, where you were talking about the kind of direct ownership versus wrapper ownership. I think it'd be good for the listeners if you could maybe expand on that slightly and explain the benefits of each one.
Yeah, so with direct tokenization, and this is something that Securitize is working on. It's essentially holding a stock in a U.S. brokerage account. You have full shareholder rights. You get dividends, and it's no different than holding an equity in your brokerage account. But right now, a lot of the equities that we see on chain are synthetic wrappers. They're claims on an SPV, special purpose vehicles. So they don't give you those voting rights. It's essentially just price exposure, and it's great. It's scaled because there's demand in emerging markets, and for people who can't get exposure to these types of stocks, to be able to buy it on chain. And I think it's a great first step. But there's a clear difference in where the space is headed, especially as these traditional exchanges move on chain, of course. And a second part of it is that institutions are not going to touch synthetic wrapper versions. They have mandates that they need to follow. So like I had mentioned, with the regulatory and development side of bringing these exchanges on chain, I think their equities are the closest to it, and hopefully by the end of this year or beginning of next year, we'll see that convergence outside of just hearing about it on the news.
Okay, big prediction. That's why don't we switch gears slightly here? Dennis, we're seeing that DeFi protocols are listing tokenized assets as collateral and building vaults, which is obviously directly related to what you guys are doing at Midas. We're also seeing that traditional custodians and exchanges are moving on chain, as we previously discussed. Who do you think ends up owning the distribution layer for these tokenized assets? Do you think DeFi protocols, or do you think it'd be the traditional incumbents or some kind of hybrid structure?
No, great question. So I think it really depends on which asset class. Amir had mentioned some really interesting assets, for example, commodities and gold that clearly have product market fit and a really great product. These products, because they're regulated as commodities, are largely accessible within many of the crypto CeFi institutions, so centralized exchanges, many custodians that are effectively following the same regulatory regime than Bitcoin, ultimately being classified as a commodity. So here, many centralized exchanges can actually list them. They can facilitate trading. They can transact 24/7, but they can also be traded on DeFi venues. But you clearly see very deep adoption of anything that's not regulated as a security on the traditional crypto CeFi venues. For assets that have a classification as a security, so this is, we discussed equities, clearly a security, even with synthetic. We discussed other products. Here, actually, these custodians and central exchanges often have more limitations. So Coinbase today, unfortunately, even they like to do so. They have no license to facilitate multilateral trading, and that effectively limits some of the scope. That being said, the progress is there. I'm sure now with the change of the regulatory regime, many of these large institutions are getting the right licenses to list securities. In Europe, actually, with the MiFID regime, many of these centralized exchanges already have broker-dealer licenses, simply because the futures and perps tradings are classified as securities, and sort of prepared themselves already for this. So to wrap it up from that side, I think it depends a little bit more on the asset class. The asset classes that are regulated for traditional financial assets, they definitely see a lower adoption in some of the venues that lack the appropriate licenses. So I would say DeFi protocol brings a lot more appeal here, whereas the venues that you see that have the right licenses, they certainly see more adoption for tokenized commodities.
Mm-hmm. Okay, interesting. Yeah, there's definitely a theme emerging here on the regulatory side. We've heard commodities be mentioned quite a few times. I'm curious, Amir, if in your analysis, or Dean, just on RWA.xyz, what kind of mix are we looking at here? Is it mostly tokenized gold, or are we seeing other commodities being traded? Either of you jump in, I don't mind.
Do you want to take it? I mean, from our own analysis, a majority, of course, is gold, but there's been an uptick definitely in things like diamonds and some agricultural products as well being moved on chain. But I think you can definitely line up with how gold was performing and the AUM of gold, as far as on chain spot holdings growing. A majority of it is just driven by people wanting exposure to gold, and like Dennis was mentioning, using it as collateral and so forth. But yeah, I mean, Dean, go ahead if you're seeing anything different.
No, I mean, largely agreed that both in terms of the issuance side and the allocation side, gold is by far the market leader in terms of tokenized commodities. That said, I'm actually seeing some interesting issuances coming to light over the next couple months, and spoke to a tier one chain yesterday who's going to be tokenizing uranium, palladium, and some other kind of other precious metals, which I think would be pretty cool in terms of the exposure front. So yeah, I mean, traditionally, just like gold's the biggest commodity by market cap, I think that will follow on chain. But I'm seeing some pretty cool other exposure opportunities, mainly on the primary market side. Again, haven't seen too much activity in secondary markets yet, which is yet to be resolved. But yeah, it's largely what I'm seeing.
Interesting, yeah. 30x private market coming on uranium soon. Okay, cool. So look, one finding that I thought was very, very interesting and kind of went against everything that I thought about on-chain yield, at least for the last few years from the report, was that these tokenized treasuries are often offering much higher rates than DeFi stablecoin lending rates. And I believe, correct me if I'm wrong, Amir, but you were looking at the RWA, probably on Ethereum, USDC and USDT lending rates as a proxy there. And I think that the report actually said the majority of days since mid-24, the rates on tokenized treasuries have been higher. And since year to date, 2026 or Q1 2026, 98% of those days, tokenized treasuries have been higher. Dennis, it would be good to get your thoughts here, given you're so close to the source. What do you think is driving this dynamic in terms of the rates being so low on chain relative to those tokenized treasuries?
Yeah, great topic, and really interesting topic. Actually, it's quite surprising actually when you really think about it, right? The money markets on chain have a different cost of capital or different interest rate than traditional money markets or SOFR rates. When you really look at what drives rates on chain, you have to think sort of first principles. Ultimately, the utilization rate on a given market is driving the interest rate. So if utilization is low, the interest rate goes down to attract more demand. If the interest rate, if utilization is high, it drives further up the interest rate. So ultimately, it's basic economics, demand and supply. And here with these on-chain smart contract-based lending markets, Aave, Morpho, Euler, and Fluid, you effectively have interest rates that are programmed the function of the demand and supply. Now, let's take a step back and analyze, okay, what is driving the demand for borrowing? So effectively, a borrower that you see today, I would say a very large asset class, and maybe 10-20% of the borrowed volume would deposit Bitcoin or ETH into a smart contract-based lending market, and then borrow stablecoins against it. It's a very common use case. This user has demand, or effectively is making this trade if he or she expects the price of ETH to go up. Because when you do this trade and when you engage in such activity, you effectively lever yourself long ETH against short USDC. So that's ultimately the trade you must believe in. So you really sort of take a step back. Demand for borrowing is going up when the expectation about increasing crypto prices is going up. So to put it simply, as soon as the market is in contango conditions, where price expectations for future prices are going up, all of crypto interest rates are going up because people have a high demand for borrowing. There's high demand for the cash and carry rate, and that ultimately really drives up demand out. And during these periods of times, often short-lived, there's capital scarcity, so the market is going up. And this is really quite interesting when you look at it, because Bitcoin or ETH and other crypto assets, they tend to be extremely volatile. They never really grow 3% per year or 4% per year. They really go up very fast to a short period of time, which then causes scarcity of capital and very, very high rates. And then there's an unwinding process that slowly happens. So Bitcoin is sort of hovering in the range of 70 to 80K. It was last year, it peaked at something 120K. So when the market is going down and the price expectations are going low, there's actually very little demand for borrowing or subset demand. And that means the utilization rate of these smart contracts is going low and low and low. So this actually is really sort of, it's basic supply and demand. So to summarize this, the interest rates on on-chain money markets is driven by supply and demand. Demand is high when price expectation of crypto assets is high. and vice versa. It's going the other way. And this is really a use case for example, what Amir has mentioned, tokenized treasuries. If you earn a high yield on tokenized treasuries, then you can borrow on USDC on Aave, for example. You can deposit tokenized treasuries into Aave and do the carry trade and effectively drive up utilization with tokenized treasury as collateral. And that's a very common trade. You actually see in traditional financial fixed markets and fixed income. You see traditional hedge funds doing this trade all day long. This is a very common trade. In crypto, they call it looping, and traditional finance, they call it the leverage carry trade, and effectively exploiting the differences in interest rates across correlated assets. So yeah, it's quite interesting. A lot of the volumes of the assets in the issues is driven by these dynamics. Today, when you look at some of the markets numbers you've mentioned, it's effectively low single digits. When in traditional finance, you have almost rising interest rates again to some extent because of the fear of inflation. So I think that's really quite a disconnect and quite interesting, and ultimately driven by the steep volatility of crypto assets.
Okay, yeah, fascinating. I'm wondering whether, just listening to you describe that there on the demand side, previously we might have seen like some demand for leverage, right? Looping leverage with stables, which has been maybe replaced by perhaps obviously borrowing from a very isolated source of capital, not the kind of Aaves of this world. Do you think that might have played into it as well as perp volumes have shot through the roof?
Yeah, so perps are not a new concept. I mean, you have perpetual futures on Binance as early as 2012, 13. I mean, this is or on centralized exchanges, Bybit and others. So ultimately, what's driving this is really where traders prefer to trade these assets. Centralized exchanges and even decentralized perps exchanges have very large volumes, but some capital providers prefer to get exposure via DeFi lending protocols, and they can coexist, and they do coexist in practice. And then the sort of the decision in which venue to go to is really around the interest rates. So if there's a mismatch in supply and demand across centralized exchanges or DeFi venues, there will be a correction. As professional trading, I'm sure Keyrock engages quite heavily in those that correct for those rates. And I think there's some structural reasons why some people prefer to be on-chain. I think some structural reasons could be that you don't want to have Coinbase or Binance as counterparty for a number of reasons, your beliefs, your status, your qualifications. But ultimately, it's sort of driven by fundamental economics, supply and demand, and corrections to rates.
Okay, brilliant. Thank you for the insight there. Amir, why don't we come over to you for this one? This is something that surprised me a lot reading through the report. It states that less than 10% of tokenized assets are actually deployed into DeFi. So the majority of RWAs are kind of just sitting there idle. And that's a huge gap. So I'd be interested to know, why is the gap there and what needs to change for the gap to decrease?
Yeah, so, one of the things, I was thinking about when I was, going through the report is, as far as like, the gap being there, one thing I realized is a lot of these assets don't actually need, much active DeFi usage. And, it's the same in, traditional finance. You have private credit where, the secondary market turnover is like, exceptionally low. I would bet it's, below 1%. You have, gold that is typically a pure buy and hold. People are looking for exposure to a safe haven. They don't tend to transact with it that much, which is quite surprising what we saw on chain. Then you have equities, which again, most of these brokerage holdings aren't lent out or pledged or posted as margin. And for treasuries is the only one that I was like really surprised at, because like I was mentioning earlier, I believe they're a much stronger product as far as posting as collateral than stable coins, because you're natively actually earning yield while you're doing it. So to answer that first question, I think there will be a bit of a gap there, and I think it's just quite natural. Now, for usage to increase, I think you need to give institutions the confidence to transact, and one can be about for them to be insured to transact. And I'm not sure if insured is the right word, but currently institutions are testing the waters, so they need to know if something goes wrong, there's an actual way to handle it. And without that, they won't be moving size on chain. Of course, we've seen what's recently happened. I mean, in DeFi over 6-7 years. I mean, this space has been trying to gauge risk and understand the risk and composability across different protocols and different chains for quite some time now. And a lot of the work here has been internalized across trading firms and trying to understand that risk and how deploying capital. But I think protocols like Morpho and I think companies like Securitize have done a really good job of this. Securitize, one of the things we touch on is their vault registrar, which isolates vaults per individual that wants to invest. In a way, you're isolating your risk to a specific type of market. And another part of it, I think, for usage to increase is, much of the rates that we see in DeFi is variable, which hinders the institutional back offices. These are things like, filings, their audits, their modeling. They all need, predictable rates. And again, like, Morpho V2 and Pendle's principal tokens are early fixes to this, but they're still pretty early in their adoption. So until fixed rate is default, I think institutions are still a bit wary to put capital on chain, regardless of the yield they're getting.
Yeah, fascinating. I think you're right to highlight the institution there, because it seems like there's a bit of a disconnect between DeFi and the rails that these kind of assets are deployed on, and then the consumers of the assets, right? I was looking at the tokenized treasuries, which is obviously the biggest segment earlier, and something like Biddle, which Securitize wrote, which I think it's qualified investors only, 5 mil minimum investment. Similar thing for Circle's USYC, right? So it's like the actual retail people who would be using DeFi completely shut out of most of these other products. So yeah, you're right. I think once the institutions get comfortable, then we'll start to see them being deployed, not the other way around, with retail going into more of these RWA assets. Is it possible that maybe looking at DeFi is slightly too narrow? Because I know that Biddle, I think you can use it as collateral and Deribit and other things off chain. So maybe they are being rehypothecated and used as collateral in certain, should we say, like crypto related or even finance related products. It's just not necessarily on DeFi rails. Is that fair?
Yeah, I mean, I think we saw like a wave of announcements over the last few months with like Citadel and Layer 0, Uniswap, Morpho with Apollo, Uniswap with BlackRock, and these traditional finance institutions taking stake in tokens. And personally, I think it's a play on infrastructure, and it's a play of getting a stake in the protocol to be able to have a say in infrastructure. And eventually, I mean, we're seeing it with stablecoins. Eventually, the lines will blur between these tokenized versus traditional assets, right? Because the whole game of what we're talking about is just making an asset more efficient. Now, whether we call it tokenized or not, I mean, that's just where it lives on, right? Like, it'd be quite odd to call a traditional asset whatever asset based on the infrastructure that it's living on. So I think eventually, DeFi will be blurred with traditional infrastructure in a way that the end user, won't really know, or they frankly shouldn't care. So I think the two definitely are converging.
Mm-hmm. Okay, thank you for that. Right, moving on. The industry keeps building for institutions, but the biggest crypto distribution channels that we see are wallets, especially from the number count of users as opposed to actual capital, AUM. And wallets, I think they have something like over 15 million retail users. Dean, I'm interested to get your thoughts here in particular. Do you think that the real unlock for RWAs and tokenized assets is actually going to be retail as opposed to institutional for the products that maybe they're not shut out of from a minimum investment perspective?
Yeah, I suppose it depends how you define kind of unlock and what the goal is. I don't think the answer is binary. I think it depends on the asset class. Actually, earlier to Dennis's point, I mean, it's pretty clear right now that the average holder of an on-chain treasury right now is a kind of crypto native enterprise or crypto native institution and not retail. I mean, like you said, Biddle, I'm pretty sure Biddle's minimum investment is 5 mil. USYC is slightly lower. I think it's 100K right now, but yeah, still pretty high for a retail player. Whereas growth in tokenized stocks can be largely attributed to retail now, kind of at, I think 1.3 billion in distributed asset value. So largely, I think it depends what you're measuring against. I also think as time sort of perpetuates, these markets are going to follow the 80-20 principle like anything else, where we'll look back in 10 years and see that 90% of the holder count of any given asset is probably retail, but within that 10%, which is institutions, that's probably where the majority of value is held. And I was speaking to a major tokenization platform, and I can't name the name, but they've issued a lot of their own products, and they're also a traditional financial asset manager. And I think the statistic was 90% of their holders of their products are retail, but 95% of the value is within the remaining 10% of institutions. So I think we're going to see a lot more of those scenarios. And I do think we're slowly getting there with institutions. I mean, like I said, we have crypto native enterprises, we have exchanges allocating their treasuries, we have VCs, we have liquid funds, we have hedge funds. Probably the last big mammoth to knock over and get on board are these big banks. But I think people sometimes forget that they are, huge organizations that take a long time to move. So I genuinely think that a huge factor here is just time. And look, we're in a nascent space, and trust takes time to build.
Yeah, 100%. I mean, it feels like as an industry, we've been talking about it for 5 years, but we're really coming towards the idea of like a DeFi mullet now, or something along those lines, right? Okay, well, look, we're approaching time, so I just want to ask you one last question to wrap up the discussion here. It'd be great to get all of your thoughts on a bit more of a broad, forward-looking question. Dennis, why don't we start with you? What do you think that tokenization needs to look like in 18 months' time for us to say that we've scaled successfully?
I think we discussed this quite a lot in the last 45 minutes. So I would say, actually, traditional banks, traditional financial institutions, traditional funds adopting those assets. I think I'm less concerned about the number, but I want to see real use cases. Case in point, I just saw an announcement about DoorDash accepting stablecoin payments in Stripe. And that's a good use case. That's really around real world use cases, and this is on the Stripe blockchain, just FYI, so Tempo. But it's really around building real world use cases that brings the industry forward rather than intrinsic trading and speculation on its own price movements, which we described a little bit on this earlier. So this requires bringing assets on chain, but also real financial players, real economy adopting tokenized products, be it stablecoin, be it tokenized assets or assets in general.
Mm-hmm. Yeah, couldn't agree more. Everyone get ordering on DoorDash to prove it the right move. Dean, any final thoughts to wrap us up here?
Yeah, look, I think Dennis is largely right. We want to see real use cases, real institutions coming on chain. I'll probably give a bit more of a tongue-in-cheek answer, whereby I want to see at least $100 billion in distributed asset value. I'm a numbers guy, so as long as the number keeps going up and to the right, then happy days.
Okay, yeah, well, everyone will be looking at your platform to see it, so love that. Amir, you want to wrap us up?
Yeah, I mean, I fully agree with Dennis. I think, outside of usage and looking at, the stats, I think the key goal here is to make tokenization like becoming invisible. The whole point of Stripe, acquiring Bridge isn't so that they can keep talking about stablecoins, but it's just a back end thing which they can, you know, help increase efficiencies, and the end user just sees a dollar, right? They don't need to care whether it's a stablecoin or, you know, a fiat. And, you know, the same thing can, you know, happen with tokenization, right? Like if a brokerage settles on a blockchain, you don't need to know or care. Or, you know, a fintech's, you know, earn program, if I see that and it's running on tokenized treasuries, you know, and you just see the yield in your app, I think those types of things are a major win. And so in itself, you know, in that, you know, it stops becoming, you know, a category, but rather just, you know, part of like, you know, a product that people use. And I think another, you know, point that I'll make that, you know, I think is a major win is actually seeing this infrastructure convergence, right? So if we do see like, you know, equities, you know, trading 24/7, and we get like, you know, the first breakthrough with, you know, traditional infrastructure moving on chain, and traditional exchanges improving, you know, their exchanges by moving onto blockchains, I think that's also a big win. So hopefully it happens over the next, you know, year or two.
Okay, brilliant. Couldn't agree more. Okay, well, look, I think that's a great place to wrap up. I think there's been a few very key themes throughout this, but it's clearly from today's discussion that tokenization has kind of moved past that we can do this stage. We see this with a few of our panelists today, and now we're at a place where we're trying to really scale that infrastructure and regulatory frameworks and all of these pieces that allow us to get to the trillions that are being forecasted in the next few years. So it will be exciting to watch how all of these forces converge as RWAs develop further. I want to say a big thank you to Amir, to Dennis, and to Dean for a really insightful conversation. And thank you to everyone who joined us today. If you haven't already, I'd urge you to go and check out the full report. There's a lot more key findings in there. And I'm sure if you wanted to ask Amir or any of the Keyrock team any questions, or the Securitized team, then fire away. But otherwise, enjoy the rest of your day.
Thank you. Really appreciate it.
Great.
Take care.